What's going on, y'all? Welcome to another episode of Weeds Weekly with yours truly, Kevin Weedmark, aka the Mortgage Mouth. And yes, I am coming to you late. Yes, I know it's Wednesday. Hey, had some stuff, family stuff, time with my son, his girlfriend was in town, and just, I relish those moments. I relish time with the ones you love the most. Especially my kids. I mean, that's just the way it goes. So my apologies about coming to you a little late, but not much has happened earlier this week. And if you missed me so much, please don't hesitate to give a subscription to the Mortgage Mouth. I've been dumping the daily dose. It's a 2-minute, less than 2 minutes, let's just say. It's very damn close, but less than 2 minutes of just what happened that day in the marketplace. So what we do at Weeds Weekly, a little bit longer format. I'm gonna try and cut it short a little bit here today. And essentially, just kind of go over what happened last week. What can we expect this week? We're gonna talk about thinking big picture and why that matters moving forward. And then we're gonna talk about always add value. That's gonna be our other thing. So last week, I kind of use the thing. I don't know if anyone's ever seen like SNL, or the Jimmy Fallon show, and he did the Ew. He's done it with John Cena and everything like that. And it kind of reminded me of the fact that inflation is still sticky. While we got inflation data last week, CPI, PPI, it is still showing just how persistent it is. And PPI kind of gave an indication that it is remaining persistent. So it's one of those things that we're 2 years in. The Fed has been working on it for 2 years, and it's still sticky. So which means to me, it's not going to go anywhere fast. I think we're going to be living with it here for a little bit, but I'll explain later why I think it's going to kind of fall out a little bit. The other thing is, hey, they passed CR, continuing resolution, but all they did is they passed it to September 30th. Once again, just kicking that can down the road. Congress just simply cannot help themselves. They have a spending problem, and the last thing they want to do is really reel that in. Although they didn't really add anything to it, they just kind of kept everything even, which to me is a clear problem given we have over $36 trillion in debt. Better than having it, the government shut down. However, I think it would have been better if it did, and they just need to, instead of waiting till we're like a week out and say, well, we need more time because we got to discuss it. You got 6 months. How about that? You have over 6 months right now to figure this shit out. Do it. Do your job. I get you got a bunch of other things swirling around, but it's your job. That's why we voted for you. The other thing is, what do we got here? Mortgage rates are winning big. Uncertainty, as much as we all may hate it, and often it puts our clients in quicksand. At the end of the day, the biggest winner right at the moment is interest rates. Interest rates have been the biggest receiver of the uncertainty. All the markets have been lower. The consumer has moved a little bit more into quicksand. We can see retail sales pulling back, all that stuff. But the biggest winner has been interest rates. And I think that's going to continue for about another 3 to maybe 5 months. So we'll talk a little bit more about that probably at a different time. So coming this week, it's going to be show me the money. We already got that data. It's Wednesday. Cheat. Retail sales already came out. They were a little bit better than anticipated in the core number. So the overall number wasn't as good, but the core number is where they take out autos, they take out gas, they take out those type of things, energy component. That number actually went up, showing the resiliency. Once again, the consumer may be back a little bit, but at the end of the day, they're not running away like they were last month. So that was big for the market to digest. Our first of the year, the other big thing that we're going to see this week, and it's actually today, and it's a little bit later today, we're going to get our first dot plot. So we're going to get our second Fed fund policy meeting. They're not going to do a damn thing. They're not changing the Fed funds rate. Their vernacular may change a little bit, and it's really going to change, I think, with the fact that they're going to back it up with the dot plot. So the dot plot is being released. It's where they kind of give a future forecast of where they believe interest rates are going to be Q2, Q3, Q4. And we can mirror that against the last one that we got, which was in December of 2024. So it's going to be quite interesting to see, with all tariffs, with debt ceiling, with Doge, with the new administration, what the Fed is actually thinking. And you can be certain traders are hinging on that and are going to make moves based on that dot plot today. Do I think it's going to be a major mover? I don't. If anything, I think it's going to work more favorably for us, although I think it's going to be a little bit further out trajectory than what the market has built in right now. But I don't think that's going to be a necessarily bad thing, because overall, there's a lot of uncertainty, pun intended, of when the Fed is going to adjust that Fed funds rate again. So we'll see. The other thing we're getting also a heavy dose of this week, and we've already got it, is housing information. And that's really important for folks like us. Housing starts, existing home sales, building permits, all up. Last month, we had a total crash. So it's good to see, and builders are always kind of on the forefront of costs and goods and services to actually get that home from ground zero to get it up. So they're starting to see that demand again. They're seeing that these lower interest rates are creating the consumer to come back into the marketplace, and is creating a demand. So they're going to pick up their game a little bit, which is a great sign for us in the industry. The other thing I'm going to talk about is thinking big picture. You know, inflation for the past 2 years has been the talk of the town, make no mistake about it. And for the right reasons, right? I mean, when you have 9% inflation, I mean, it's like sound the alarm. Every goods, services, everything's increase. We're really seeing that pendulum shift a lot lately to where it's the overall look of the overall economy, which I think is a great thing. Because in essence, if you have a slowing economy, everything's going to pull back. The labor market's going to squeeze. Inflation's going to squeeze because the consumer's going to spend less money, right? It's uncertain times. The economy is contracting, which means the consumer is going to spend less, and it's just basic economics, supply and demand. If you have less money chasing goods, you're going to see those prices trickle down a little bit. So overall, this change, this dynamic that we're moving into is anti-inflationary as well. The thing that's really kept it high and the uncertainty has been the tariffs and that game, but time will tell where that plays in. But the overall feel, and that's why we see this temperature of rates coming down a little bit without Fed interference. And then the last thing is we always want to add value. If you subscribe to my weekly newsletter, you got a chart earlier today in your email, and it showed payments. It showed payment differences, right? For rates a quarter down, a half down, at different loan amounts. And it's all about touches, adding value to our clients, saving them money, helping them understand market conditions better. Doing things out of the box when not asked is how you stay top of mind. So that chart, if you're hearing this, you'd like a copy, is a great opportunity to touch your clients, specifically if they had a closing in October of 2023 that you handled, or even in early January of this year. The timing is right to do a no-cost refinance potentially, depending on obviously their circumstances, or just a straight-up refinance altogether. Because at that time, you were in the high sevens, and we've come all the way down to maybe the mid sixes to lower sixes, to even depending on your situation. We're definitely in the 6% range, and I would guarantee that you would save at least a point on your interest rate. All right, y'all. I hope you have a great rest of the week. Once again, please do not hesitate to jump on YouTube. Give a subscription to the Daily Dose. Would love to have you on board, cutting some content every day, and you'll get a great read on what's going on in the marketplace, and you'll stay well informed. All right, y'all, have a blessed week, and I will talk to you on Friday with the Friday wrap up. Cheers.